Hey everyone, welcome back to the channel, your number one source for income-oriented investing. It's time to go over the high-yield income landscape on the U.S. stock market. So to my American friends, this is definitely the episode for you. We're going to be focusing on some of the top, if not almost all, the top income-oriented covered call ETFs on the U.S. See if there's any updates, give you a rundown of what's going on. Sorry about that, I just got a text. And but first we'll check out the stock market news, how it's been doing, how the major indexes have been doing in the last month. So nothing short of a disaster in the last couple of days, in the last week or so. So just for context, I am filming this on August the 7th. The stock market basically just closed, and the S&P 500's down another 40 points, almost 1%. But if we just, look at the past month, you'll see that there's been a big drop, especially near the end of July and August here. So minus 6.70%, the S&P 500. And NASDAQ much worse. The NASDAQ took another tumble today on August 7th, and down another 1.23%. And in the last month, down almost 13% in 1 month, which is pretty incredible. Russell 2000, however, still has been doing pretty well in the last month, but if we just scroll out the last 6 months, you see that as of mid-July, there's been a spike with the Russell 2000, which is the index that covers 2,000 small cap, medium cap companies. And I think this is because there's just some talk of a rotation out of big caps into small caps, and sheep tend to follow each other. So that's what I think happened. But you see that a big drop here, almost neutralizing the sharp increase in July. So I think that interest rates will probably get cut in the next Fed meeting. I'm sure this is the nail in the coffin. I'm sure they're going to decide to reduce the interest rates. By how much? I don't know, 25 basis points, 50 basis points. I have no idea. In Canada, they already started lowering interest rate, so I think it's going to happen. We'll see what happens. But I mean, come on, guys. If you look at the 1 year, the S&P is still up a whopping 15%. The NASDAQ up 16%. So it's nothing to be really afraid of. This, market can't just keep going up forever, right? There needs to be a little bit of some sort of correction, some sort of reality check. So this is maybe a scary time for you, because the drops are usually sudden and fast, whereas going up is a little bit more smooth. You know what they say, stocks take an escalator to go up, but an elevator to go down. So just stay firm, stay the course. And don't forget about the news. Everyone's just trying to figure out, like chickens without heads, what's going on. And it's just a little needed correction. The VIX spiked. Now it's a little bit, it went back down to maybe late 20s, early 30s, the VIX index. So if we just look it up here real quick, the VIX today still down, but I mean, if you look at the last 5 days, there was a little bit of a spike here on Monday. But stay firm, stay the course. Now, I don't really follow the news, to be honest, and try to figure out what's going on. But if you like following and looking at some news, I do recommend the Stock Pick app. It's a mobile application, and I like it because it's politically neutral, number one, and it's designed for retail investors. You could try it out for free for 2 weeks, and I believe that for a year it's only $80. But I do have a referral link. Now, they're not a sponsor of the channel, but they were kind enough to provide me a referral link. So if you use my referral link, you can get 25% off. So only, from $80 to $60. So in case you want to, my suggestion, just try it out using my referral link, and then if you decide to keep it, you decide to upgrade and get the full year, you'll get 25% off. So moving on now, let's check out the income-oriented landscape. Let's see if there's any new funds, anything crazy that's going on, because the income-oriented landscape keeps increasing. It keeps, there's new funds. Every time I go in, there's new funds, new index, new S&P 500 covered call ETF, NASDAQ covered call ETF. There's actually 2 new ones that just came out, so we're going to go over them. But first, I like to thank the sponsor, the official sponsor of this video and of this series, Curve. So Curve is an income-oriented ETF provider. They do have a lot of single stock names. like the Amazon, Apple, Google, etc., etc. But very big news, they just came out with a brand new income-oriented ETF called KQQQ, the Curve Technology Titan Select ETF. And it does look like it's going to be an income-oriented one because they will be writing covered calls. So this is pretty much very, very new, everyone. It just came out at the end of July. There is no first distribution. The first distribution has not been declared yet, as far as I know. So this is going to be very interesting to see what this ETF is all about. I'm assuming I'll have maybe a call with the CEO to see what it's about, but we'll have to wait till the first distribution to see what kind of yield we're going to get. But it does look like a technology-specific covered call ETF. Maybe reminds me a little bit of FEPI, but we'll see exactly what this ETF is about. So super excited. Just another income-oriented, more technology-focused ETF, which could be a good pickup now because really, like we saw, the NASDAQ has corrected pretty aggressively. So it's a good time to pick it up. Anything technology or NASDAQ related. So let's start with the King of Kings. We will start with all the S&P 500 income-oriented covered call ETF. So we're going to start, of course, with the biggest one still, I believe, JEPI. So the latest distribution is a bit lower than last month's 28.9 cents. I do expect it to be probably a little bit higher next month. Now that volatility has spiked. Remember that when volatility is higher, the distributions do tend to go up. So you got your JEPI here. No major changes besides the slightly lower distribution. Now there is Bali. Bali is very, very similar and identical to JEPI in terms of the strategy, where it's not exactly the S&P 500. So it's more they're stock picking in the S&P 500, but doing covered calls. Bali is actually outperforming JEPI by a lot. But I think that JEPI is a little bit more defensive than Bali. They have approximately the same yields, by the way, 6, 7, 8, which of course could vary. The distributions will vary every single month. The latest one from Bali has been pretty high at 18.9, a little bit higher than the last two, but the highest one has been about 20 cents a month. So I just figure I'll show you because it's a really nice ETF. I mean, it's JP Morgan, it's iShares, it's BlackRock. So obviously they're in big competition. If we do the total return comparison real quick here, Bali and JEPI, you see that Bali does have the advantage. But if we look at the latest drop, you could see that Bali has dropped a lot more than JEPI. So I do feel like JEPI is maybe more defensive style of ETF, which will have less return, but you'll have less volatility. I'm assuming that's just my opinion from what I could see here, but very, very correlated the charts, right? So this is same management fee, MER as well, 0.35. But just keep in mind that Bali and JEPI, and there's a few other ones like PAPI. There's another one that I forgot about, Devo. They're not exactly the S&P 500. They're stock picking in the S&P 500, and they're writing covered calls. So now let's move on to really officially S&P 500. So of course you have GPIX from Goldman Sachs, who redid their website completely. So this is officially, from what I could tell, the S&P 500. It's doing really well. It has smaller management fee for now, 29 basis points instead of 35 basis points. But I believe that's promotional, and it will probably go away very, very soon here. Once you see the gross is 35, the net is 29. So I think it'll go back to 35 eventually. But the distributions have been fairly stable, a little bit higher yield than Bali and JEPI, which is understandable because it's really the S&P 500. So really nice, consistent, about 8% yields here. The latest one being 32.9 cents. So we'll definitely keep an eye on this one as well. So Goldman Sachs, iShares, JP Morgan, all competing, of course, for your S&P 500 covered call ETF exposure. Another good one here, very stable, low fee, not too much income, not a crazy amount of income, but you are capturing a lot of upside of the S&P 500. So if you're good with lower yield and you want to capture a lot of the S&P 500, GPIX could be a good one as well. We got a new one to the game. So a new one that was just added I'm sorry, I don't have, did I bring it up properly here? Well, it's actually this one here, I believe. Yeah, RSP. Sorry about that. All right, so brand new income-oriented S&P 500 covered call ETF with a twist from Invesco, the guys who manage QQQ, the QQQ index, and QQQM ETF. So they came out with their own S&P 500 and NASDAQ covered call ETF, which we'll see the NASDAQ one in a second when I cover the NASDAQ one. But this one is a bit different because it's actually an equal weight S&P 500. It's not a market cap weighted. So this is very different from the other ones, which are pretty much all market cap weighted. So no, zero management fee until the end of the year. This could be very interesting. Personally, I don't really know why they're doing equal weighted. I think market cap weighted makes the most sense because if you just look at the comparison, S&P 500 regular and then equal weight, the index, the regular one, outperforms. But maybe this is something that you could be interested in. There is, no first distribution that has been declared yet. This is again very, very brand new, so we'll definitely keep an eye on it. Moving on to SPY from NEOS, again, a very, very consistent distribution near the 50-cent range. You're always going to get approximately 1% a month here, 12% yield. So for you guys that want a little bit more yield than a JEPI or Bali or a GPIC, you're willing to give up more upside, SPY could be good for you. And if you like really, really, really consistent dividends, I'm hoping to do another Q&A with them recently. Or in a bit rather, because they do have a NASDAQ. They came out with a Russell, so I want to do to give you guys an update on the SPY on their lineup. So again, very, very consistent, growing very rapidly. Also, 1.6 billion in net assets. So obviously very popular. I think people really like the consistency here. You have IVVW, which is the lowest fee S&P 500 covered call ETF from BlackRock. Only 25 basis points fee here. This is a very set in stone approach. It's I made a recent video talking about this completely here. So it's just a 1% out of the money S&P 500 call. So you're basically only capturing 1% a month of the upside of the S&P 500. So the yield's going to be a little bit higher with this one because they're giving up a lot more upside, although the latest distribution was quite small at 36 cents, but I think that was for July when the VIX volatility was really low. So I wouldn't be surprised if with this one, along with the other ones, they increase their distributions. But if you want a low fee, simple rinse and repeat, this could be a good one to consider. Of course, you have the ones from Defiance. You have JEPY and SPY-T. So JEPY just did their reverse 1-for-3 stock split. I got not one, but 2 videos on it. So make sure to check out those videos if you own JEPY. This one does give up a lot more upside. It is a daily strategy. It gives up a lot of upside. So these are actually, something like this at JEPY is actually probably the best during the times like now when there's a lot of volatility because it's capturing a lot of premiums. So yeah, just did the reverse split, and let me just check the latest distribution. Yeah, that's what I figure, a bit higher than the last month, and I expect the next one to be even higher as well. SPY-T, more of a target one, so it targets 20% yield per year. I know a lot of you like this one because there's less capital going down, there's less stock price going down, but obviously if the NAV or the stock price is more stable, you're going to get less yield. But hey, 20% yield, nothing to scoff at. I really like this one in terms of strategy. I have QQQT. That's the one I invested in, the NASDAQ version of this. Basically, same strategy, but the NASDAQ index. But this could be a great option. If you like really, really high yield, but you want more of a stable stock price, this one really targets 20%. So I'm assuming the distributions are going to fluctuate a little bit based on the stock price. It's, if the stock price goes down, I'm assuming next month it'll probably go lower because it's always targeting 20%. So if the stock price is lower, the distribution should be adjusted lower accordingly. Next one, you have XDTE, another daily one from Roundhill. So this one also doing pretty well. I have to admit, I was looking at the total returns. Now, I will wait for a year to pass for all of these, and then after a year, I'll do a comparison, a video where I show all the total returns. But this one is, what's interesting about it is it's weekly distributions, and they've been going up lately in the last couple of weeks, which I find very, very interesting. Even the NASDAQ one. So if you like a daily strategy, there's really a lot of options now. Right, you got JPY, you got SPY-T, you got XDT, and you have also the one I think is the top performing S&P 500 covered call ETF for now. I know it's still a bit early, it hasn't been a year yet, but that would be iSpy. So iSpy from ProShares is the lowest fee daily strategy. It's only 55 basis points, if I'm correct. 55 basis points. They also have a NASDAQ one, which we'll check in a second. But this one, last I checked, performance has been the best versus all the other ones we saw. But you're looking at maybe a smaller yield. You're looking at about a yield of something like 8%. So you're looking at yields on the same level as a GPIX, but a little bit higher performance. Obviously, the daily strategy they've mastered. I think they do very out of the money calls. You could actually see the moneyness here of the daily call, I believe, which, 103%, that's 3.5% out of the money. That's fairly out of the money. So this is why they're probably not going to have an insane amount of yield, but you are capturing a lot of the upside of the S&P 500. You see that the yield is under 8% right now based on the last distribution. So that's it for the S&P 500 ones. Let's move on to the NASDAQ ones, which of course we have QYLD. And, I'm not going to cover, by the way, for the S&P. There's more of them, but I'm not going to cover all of them. So NASDAQ 100, the one that started it all. QYLD, doing okay, I guess. This is just a rinse and repeat, so I'm never going to have really much anything new to say about this one, except you could actually see the premiums in the chart here. So the last distribution in the 17.7 cents, so a little bit higher than the last ones. You're looking at yield of about 12%, something like that. Moving on to JEPQ, which is really getting huge AUM. I actually prefer JEPQ over JEPI because it's more correlated to the NASDAQ 100 and JEPI is to the S&P 500. Same management fee at 35. Distribution, pretty much the same as last month, maybe slightly higher. I do expect it to go up next month as well because volatility is spiking. So this one still a monster. It's absolutely growing super rapidly. You see here at 14.3 billion. So definitely the second biggest, really catching up with JEPI. I wonder if it's going to surpass JEPI at some point. But JEPI is still the most humongous one at 33 billion. So yeah, JEPQ definitely one to consider if you like the NASDAQ. A lot more correlated to the NASDAQ 100 than JEPI is to the S&P. But if you want something super correlated for sure, there's also GPIC, which is the one from Goldman Sachs. Basically, same thing as this one here. Same strategy, but on the NASDAQ 100. You're going to expect about 10% yield with this one, which is not so bad. I believe that's continuing. Let's check the latest distribution here. Slightly higher than the last month. So also very consistent distributions as well. A really nice one here. Nice basic one. And we have a new one as well from Invesco. So here it is. It's QQA. So Invesco's the guys who manage QQQ, QQQM, so they came out with their own NASDAQ 100 covered call ETF. This one just came out, so I don't have much information about it. The first distribution hasn't been declared, but of course, we're going to keep our eye on it. And just like the other one, the other new one here, RSP. Is it RSP or RSPA? I don't even know. I really don't dislike this website a lot. Okay, it's RSPA for the S&P 500 one, and for this one here, their NASDAQ one, it's QQA. Okay, so another NASDAQ 100 covered call ETF we got to keep our eye on. Again, distribution hasn't been declared, so we can't really know exactly the yield, but this is definitely interesting because these are the guys behind. They're obviously NASDAQ experts. They're behind the QQQ, QQQM. So we definitely got to add this one in the rotation. So moving on to QQQI, the NEOS NASDAQ 100, almost a 15% yield, probably is 15% yield now because of the NASDAQ's volatility. And again, just like SPY, very, very stable monthly distribution. I know many of you like that. And this one's growing rapidly as well. It's over 350 million now. Very, very nice, consistent yield. And you have QDTE, one of my favorites, the one I own in my wife's account. This one's also been growing very, very rapidly. The AUM has jumped ever since I put it in my portfolio, so I think it has something to do with that. I'm in good contact with the guys at Roundhill. I think they're doing a good job. Performance has been pretty good actually on this one. Very, very good. And again, once all of them have been out for a year, I'll do a video. But another cool thing, or crazy thing rather, that the distributions have been pretty high in the last couple of weeks. Again, these are weekly distributions. I really like that weekly compound effect. It's pretty fun. So definitely another one if you like the daily strategy. So when it comes to the daily strategy, you have this one. The next four are really focused on daily strategy. So you have QDTE, you have QQQY, of course, which declared a monster high, very high distribution. I kind of, I swapped my QQQY into this one here, QQQT. Probably the worst time to do it because now QQQY is doing well. When there's a lot of volatility, QQQY gets the most premium or has the biggest cushion. So I kind of wish I would have held on to my QQQY for a little bit longer, but the NASDAQ starts going up again, of course, you're going to be better off with QQQT because it captures more upside. So again, just like SPY-T, it's a 20% yield target ETF, and they did declare finally their first distribution to be paid out, was paid out last week. And then you have IQQQ, which is very similar to iSpy from ProShares. But it's a NASDAQ 100. I was surprised to see the same exact MER, which is good. Usually a NASDAQ one's a little bit higher. So yield about 10% here. Very, very new, but very, very high performance as well. But still too early to tell. I think it's only been out for a few months. But if we look at the latest distribution, it's been out for 4 or 5 months. Pretty consistent, near the 30-35 cent range. And again, you could see the moneyness, very, very out of the money. So they're not making a lot of premium. That's why the yield only 8, 9, 10%. But you are capturing a lot of the upside of the NASDAQ 100. So it's all about figuring out which one is best geared towards you, right? So moving on, finally, last but not least, the Russell 2000 one. So I know many of you have been interested, and there's a lot of talk of the Russell. A lot of people are switching to it because, I don't know, because of interest rates, because of some, I look at things from a long-term perspective. I like the big caps, S&P, NASDAQ better than the Russell, but maybe it's a good time to invest in small caps now. I don't know. If you are interested, you got 3 great options here. There's still RYLD, XYLD. I don't really count those anymore because I think there's much better options. So first option is IWMW from iShares. This is going to be the lowest fee one. A rinse and repeat strategy, 2% out of the money. So you're capturing up to 2% a month of the Russell 2000. You're capturing a little bit more than the S&P 500 one. And it's fairly high yields. I mean, you're looking at the monthly distributions here. So 52, 63, 50. So, 52 cents, if we just times it by 12 to get the annual, just to give us an approximate idea of the yield here, you're looking at a very high yield of over 12%. So probably between 12 and 15% with this one. Obviously, it's going to fluctuate. Very, very high yield. So this is a low fee one. NEOS has their own. The fee's a little bit higher at 68. It's 68 for all 3 of their ETFs. And the yield is pretty high, 14%. I'm surprised it's a bit lower than their NASDAQ one. I thought it would be higher. But they have the first 2 distributions. The second distribution, which was much higher at 60 cents. So we'll keep an eye on it. But, for this one and their NASDAQ one, I do expect in the range of 13, 14, 15% yield. And then you also have the one from Defiance, IWMY, which also declared a monster distribution here, 88 cents last month. And the T version should be coming out shortly. So there's SPY T, QQQT. They're also scheduled or planning to come out with the Russell 2000, probably 20% target yield one as well. Once it comes out, we'll add it to the rotation. So guys, it's just getting crazier and crazier with these index option covered call ETFs. There's a million of them now. They all have different strategies, monthly versus daily, set in stone, active. All of them have no leverage yet. That's what I'm waiting for next, leverage versions to come out. Two new ones to the fray, the Invesco ones. Next time I'll make sure my bookmark is good. But yeah, it's I'm going to be keeping a close eye on all of them. And once they are all out for a year, it'll be good to compare. But it's not rocket science, right? Typically, you just got to figure out how much upside you want to give up versus yield you want to get. If yield and defensive, if you're more bearish on the market, then you want the ones that have more covered calls, more yield, but you're giving up more upside when the markets go up. So it's really up to you to figure out which one is best for you. So now that the index-based ones are done, let's move on to the other ETFs now. All right, everyone, moving on to alternatives, some sector-specific and fixed income, as well as closed-end funds. I'm out of breath doing this video. It's exploded on the U.S. market. What can I say? Amazing time to be an income investor. So we'll start first with my personal favorite one, or one of my favorite ones, SVOL, which just got a 5-star Morningstar review. And I'm very excited to tell you that I do have an upcoming Q&A with Larry Kim, where we go over SVOL, the recent changes it's made, how it's performing with the VIX spiking, how it compares to another VIX short ETF, ZIVB. Many of you have been asking about this. If you like SVOL, you own it, you're planning on owning it. Very, very amazing and important Q&A video to watch coming up in the next couple of weeks. So just past $1 billion AUM, by the way. So yes, SVOL did take a hit because the VIX spiked, but really not crazy, right? That's because of all its hedging, all the hedging it does, which I'm going to talk about in the Q&A. But solid performance, consistent monthly distributions at 30 cents a month. And another thing I noticed, and I'm going to talk about this with Larry, is the increasing. And look at that. They just changed it and added high. They added the high ETF in here. So what they're doing is they're going less and less in the treasuries, getting more and more out of the short-term government treasuries, not entirely, and putting a lot of the assets in some other ETFs, which are very fixed income oriented. You have AGGH, which is fixed income, CDX, fixed income, high yield bonds. You have high, which is more just regular income, does bull call spreads, which, I'm happy to see that they actually added it. I was wondering why it's not there. Mortgages, this is actually their biggest ETF, and Buck, a very stable cash alternative. So I really like personally what they're doing, because why go in short-term treasuries all in on that when you could put it in some other ETFs, their own, that generates high yield. This just helps to sustain the monthly distribution of SVOL, I think. And again, talk about that with Larry. Moving on to high is another one which kind of maybe a bit lower risk and more stable than SVOL, but less reward, less risk. This one just does a lot of call and put spreads to generate income, has a lot in T-bills as well. So pretty consistent distribution, although it's been 20 cents for a while, then 16, 14, 14. Now it's back at 20, so we'll see what happens with this one. But fairly consistent, decent return. Definitely not as high as SVOL. I prefer SVOL. You see, SVOL is almost double here, average return. But definitely doing okay. THTA, very similar. By the way, THTA managed by Jay, the guy behind who manages YieldMax. He actually manages this one as well. This is under the Tidal umbrella. So YieldMax, Define CTFs, Tidal. They also manage this one here. Pretty nice high distribution rate, much higher than highs at 13%. And I would say pretty similar performance to high as well. One point it was beating it by a long shot. Now I don't really know. I haven't checked up on it, but I don't even think it's a year this one has been out. So we'll wait. Yeah, it only came out mid-November of 2023, so we'll know more when a year is out. But you're looking at maybe 5, 6, 7% annual yield, something annual return, something like that. Moving on to YieldMax, of course, which just keeps adding more and more and more ETFs, which will eventually be added to a YMax, which is my favorite one. It's the all-in-one. It's the easiest way to just get access to all of them. That's just my opinion. If you're more of a diversified, income-oriented investor like me who doesn't want to stock pick any of these, but if you want to, you could play these with stock picking as well, but you're taking much more higher risk, of course. So you got the Snowflake one that recently came out. Airbnb recently came out. I think they just listed recently another one, Alibaba. And then you have the Coinbase and Nvidia short one. So the short ones will not be added to YMax. But yeah, and I think they just came out with a prospectus. They have another 10 that they could come up, another single stock one. So I like YMax. They're kind of building their own index now. There's going to be more and more companies that are going to be added in YMax. So yeah, just, you know, very varying distributions every single month, very high yield. And in my opinion, the best way to play these is you really, if you're investing in the individual ones, you better like the stock, because it's the same risk as owning the stock individually. But the easiest way to play them is just to get YMax and put it on drip. That's just my opinion. Moving on to some sector-specific ones, you have FEPI and AIPI, which focuses on technology companies, and this one focuses on AI especially. So these could be a great pickup now because the sector is down or took a big hit, and you're looking at pretty high yields. And AIPI, I guess they did release their first distribution, as expected, much higher yield than FEPI because it's more AI companies which were probably higher volatility. So AIPI, FEPI could definitely be a good way to capitalize on the technology route that's been happening. Very interesting here. So this is some of the very few sector-specific covered call ETFs on the U.S. Pretty good, decent MER at 0.65. But yeah, $1.48 for the first distribution. Now, this could be higher than normal because maybe it's like 40 days worth of distribution, not a month. So we'll have to see next month how that happens. My estimate, it'll probably be in the low 30s or maybe a bit closer to the FEPI range of, you know, which has been a very consistent, actually, 25%. Crane shares is Crane shares, right? There's Clip. Clip is another favorite one of the community if you want to invest in the Chinese technology sector. I don't think it's taken a beating as much as the NASDAQ, but very consistent high distributions as well, which of course are going to go lower and lower. And I'm assuming they're going to be doing a reverse split on this one eventually. They'll probably not going to have a choice, right? Anything that has over 30-40% yield has to do a reverse split at some point. There is no choice because they're giving out so much income that the stock price is just keep going down and down over time. It has to, because you're getting the NAV, aka the stock price, you're getting it in dividends, right? So if you keep reinvesting with drip, you'll be completely fine. But if you're spending all your income, which is fine as well, you got to expect the capital or the stock price to go down over time. And I'm sure they're going to announce a reverse split at some point. It's just inevitable. Moving on to YBTC to Bitcoin now. You have YBTC, which of course has been very volatile lately. Took a big hit. The last distribution much higher than last month at $2. So if you want to invest in Bitcoin, but you're skeptical and you want to invest more in the volatility, if you're an income investor like me, you got YBTC as an option. You got Maxi as an option as well. This has more Bitcoin upside than YBTC because they don't do covered calls on Bitcoin, but they just do call spreads, put in and bull spreads to get a little bit of income. It's basically like the high ETF with Bitcoin exposure. That's what Maxi is. And I was a bit surprised. They did declare a massive $1 dividend the last month, But I'm not really surprised because, at the end of the year, last year, they declared a massive $4 one. This is just because ETFs have to pay out all their capital gains. So I'm assuming it'll go back to 15 cents next month would be my supposition. And maybe in December, there's going to be another big dividend. That's why BITO has to give out monthly income as well, right? So yeah, these are your two Bitcoin income-oriented ETFs. Of course, Yield Max, there's one as well, right? Yield Max now does have a Bitcoin option, which is, they have MicroStrategy, they have Coinbase, but they actually have Bitcoin, so they do covered calls on BITO. So very similar to what YBTC does. Moving on to fixed income. So you have AGGH, which is kind of like aggregate bond, which includes everything, all types of different bonds. This one is fairly stable, nice low management fee. If you like fixed income, you want an all-in-one solution, this would probably be a good recommendation. Distributions fluctuating a little bit between 14 cents and 12 cents and 20 cents here. So have gone down a little bit. Then you have your iShares, which are more specifically on a certain set of bonds. So you got TLTW, which is obviously covered calls on TLT, which is government bonds. Your LQDW on investment or good quality corporate bonds. And then you have HYGW, which does cover calls on HYG, just regular junk bonds, high corporate bonds. HYGW is doing the best one, is doing the best performance for now. Moving on to finally closed-end funds, you got CLM at about a 9% premium. Not bad at all. I'm just showing this because you guys have requested that I keep showing it. So yeah, under 10%, I guess you could pick it up. But again, I wouldn't own this if you're Canadian. The special thing about CLM is if your broker drips it at NAV. If you're not dripping it at NAV, I don't see any reason to own it, in my personal opinion. Then you got a couple of all-in-one closed-end fund solutions. My personal favorite is RIV, which is back at a small, still trading at a small discount of 3%. So a good pickup here, which just has multiple closed-end funds in it. Uses leverage as well, very highly leveraged. If you just want a simple ETF solution, so RIV is a closed-end fund that holds other closed-end funds. If you just want the ETF, there's a few options. The best performing one is definitely CEFS. These guys just know what they're doing. You're looking at a yield of about 8%, but the performance has been nothing short of spectacular. So if you want an all-in-one closed-end fund solution with the highest return, I would definitely consider looking at CEFS. And there's other ones. There's YYY by Amplify ETFs, the guys who do Devo. This one has a bit of a higher yield, but the performance hasn't been super good. They've been doing some changes with it over the years, but yeah, and there's also HIPS as well, which is a combination of all different types of alternative sources, basically MLPs, BDCs, REITs, and closed-end funds, with falls under more the alternative category. It's not performing super well, but the yield has been fairly stable at 10%. And then if you like BDCs, especially like BDCs, you got the VanEck BDC Income ETF. Very nice high yield of about 11%, something like that. This just combines all the BDCs in case you don't want to pick and choose them. So that's it for the review of this month, everyone. It's getting bigger and bigger, crazier and crazier. So, of course, there's going to be deals. I think the best sector, the most undervalued sector by far is technology. So if you are okay to take some sector-specific risk, obviously if you want to invest in an index, it would be the NASDAQ 100 because that's very technology-focused. But if you want to go deeper, you don't mind taking a little bit more risk and go something sector-specific only, you got FEPI, you got AIPI, and now you even have the latest ETF from Curve, right? KQQQ, which we'll find out soon, I'm sure, all about it. So that's it. We're going to do this again next month. So again, stay focused. Don't panic. Keep adding dollar cost averaging, buying as much as you can, increasing your units and income every single month. That is what the income strategy is all about. So see you next time. Don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and U.S. stock markets. And the good news is you'll only ever have to buy it once, because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and Passive referral links below. So Questrade is the broker that I personally use, and Passive is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And Passive, I have half off for the Elite membership. If you're interested in the Elite membership, and even if you want to start out with the free membership and upgrade to the Elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the Elite membership of Passive is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members, where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram, where you could follow us, or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.